everyone, welcome back to the channel Exanyong. In this video, we will be sharing on how a salaryman, normal working people like you and me can start investing at low cost. To start investing, of course, it requires some money as investment capital. We can start small with just $1,000, let's say, and up to any amount that we can accept in case we lose it all, based on our risk tolerance. Of course, we are not expecting to lose money when we put into any investment vehicles. As Warren Buffett once said, the first rule of investment is don't lose money. And the second rule of investment is don't forget the first rule. As a salaryman, most of our time are spent on working for others. How do we have time and energy to actively invest? The easiest way to start is by asking the experts to help us to invest our money. Do comment a yes below if you have ever been asked by a banker or any professional to invest into funds through certain financial institutions. Those funds are commonly known as mutual funds or unit trusts, where investor, any natural person like you and me, we put our money together with other people into a pool of money. Then this is handled and managed by the portfolio manager, also the fund company, to make decision on which stock, securities, bonds to buy. If the fund's able to generate profit for the year, we as the investor might be paid in terms of dividend. But the entire decision is made by the investment companies. We have no say into any decision in running this fund. Mutual funds is a form of passive investment for salarymen, people who do not have the time or expertise to make investment decisions, because we are not required to think about what to buy and what not to buy and keep monitoring the performance. And that's why it comes with a cost for the management, which we need to pay in the form of salary to the portfolio manager, the fund companies, to actively manage the funds and invest on behalf of the group of investors. The management fees usually range from 0.5% to 2%, varies depending on the funds. But this is not just the only cost. There are also various costs involved in running the fund, like trustee fund or operating costs. The management fee is just one of the reasons why mutual funds tend to have higher fee compared to index fund, which is a type of exchange-traded fund, ETF. How can a salaryman to start investing as a beginner at low cost? Definitely, you do not want to spend too much time in making decisions or monitoring. You want to invest safely by not only getting just one stock, but a basket of stocks will help to lower down the risk through diversification. ETF is definitely less fluctuating and more stable compared to one single stock, which can move up and down by 10% in a day easily. And this is the reason that it is safer to invest in ETF compared to single stock. There are many ETF available in the open market. For example, the funds that can be tracking the specific index of Singapore Straits Times Index for the top 30 companies in Singapore, US Standard & Poor's 500 or the Nasdaq 100. One of the most popular index fund is the S&P 500, as it is very well diversified to have position in the top 500 companies compared to Nasdaq 100, which only track 100 companies, or STI only track 30 companies. So for beginner investors, you could look into investing in ETF S&P 500. Why? Firstly, it is less expensive compared to mutual funds because of the management fee. Second, it is very well diversified to get exposure of the top 500 companies in the USA. Third, it is less fluctuating compared to one single stock like Tesla or Meta. Fourth, it is for buy and hold strategy which do not require active monitoring or much time. And fifth, it is very easy to buy and sell in the open market. So there are several fund companies offer this fund that track the index. The top three include SPLG, SPDR Portfolio S&P 500 ETF managed by the State Street Global Advisor, VOO, Vanguard S&P 500 ETF managed by the Vanguard, IVV iShares Core S&P 500 ETF managed by BlackRock. the expense ratio for all these 3 ETFs are just 0.03%. What does this mean? Expense ratio is the cost that investors need to pay the fund company for running the fund on behalf. So for expense ratio of 0.03%, meaning if you invest $10,000 in this ETF, you only pay $3 a year to the fund company, which is really reasonable. Compared to mutual funds with expense ratio, let's say 2%, you will be paying $200 a year to the fund company. Obviously, you could save $197 a year by just investing in the passively run index fund, which is not actively managed by any portfolio manager. Of course, this is not taking into account any potential return from the various type of funds. The historical 5-year average return for ETF S&P 500 was 12.8% per annum. If we are looking at just past 1 year return till date in 2022, yes, it is still a negative return, approximately negative 2%. This is because most of the US stocks are dropping because of the interest rate hikes and the fear of the market for the coming recession. However, if you are looking for long-term investment strategy to just buy and hold, the timing to start does not matter, as you can use the dollar cost averaging strategy to stay investor for long-term in the next 10 years. If you already save off emergency fund, you would like to start investing at low cost and for long term, here is just an idea for you to start. Hope you enjoyed the video. I will attach the links of the 3 ETF as mentioned in the video just now in the description below for your reference. Give the video a like and subscribe to our channel for more content like this. See you again in the next one.